This is Peter Zalewski from the Miami Real Estate Investing Podcast. We're doing a series of podcasts with individuals who can provide some insight as to what's going on with this notorious 2025 Condo Association financial cliff. We're about 5 months out from January 2025 when a law kicks in that's going to require condominium associations to set aside reserves so that there's no repeat of the Surfside disaster. On the other side of the break, we're going to talk to a lender who specializes in condo association financing, maybe a solution that you as a unit owner or maybe a board member is looking for. So stay tuned.
This special report examining the repercussions of Florida's 2025 Condo Association financial cliff is a podcast series brought to you by the Miami Condo Market Investing Club trademark. Founded by Miami condo consultant and expert witness Peter Zalewski in 2024, the objective of the club is to build a community to share real-time, actionable information on the latest real estate trends and opportunities in the Tri-County South Florida region of Miami-Dade, Broward, and Palm Beach. The club is ideally suited for do-it-yourself DIY condo buyers who can rely on our latest statistics, expert opinions, and access to consulting services. Club members are exclusively invited to attend virtual monthly meetings at noon on the second Wednesday of every month. The club also offers regular meetup events in person for members to network and talk shop with real estate investors, professional service providers, and suppliers. To find out more, please visit peterzalewski.substack.com. Additionally, we encourage you to listen or view our podcast wherever you get podcasts. The podcast is available on Apple, Spotify, and/or YouTube.
This is Peter Zalewski of the Miami Real Estate Investing Podcast. I am a former journalist. I'm a Wall Street consultant. I'm an expert witness. I'm also a real estate broker. Don't really practice much, but really what I'm spending my time on now is I founded a club called the Miami Condo Market Investing Club. It is a community to bring together people who are focused on the condo in and around the state of Florida. We're trying to provide real-time information, access to consulting services, as well as a marketplace to share ideas as well as networking. So as part of our objective of bringing information to the marketplace, what we're doing is a series of special reports taking a look at this 2025 Condo Association financial cliff. If you don't know what it is, basically a state law kicks in January 2025. Condo associations are now going to have to not only study to see what's going on with their building service with the physical structural integrity, but also they have to set aside money. And because of this, budgets going forward in 2025 now are hitting many unit owners with special assessments. So if you don't have six figures to basically pay off this special assessment, maybe an option is to go ahead and have your association get financing. So that's the theme. That is the process. And because of that, I am fortunate enough to bring on a senior vice president over at U.S. Century Bank. It's an institution that was created in the Miami area in 2002. They got 8 branches, are publicly traded on NASDAQ. Let me give you that ticker here real quick, just in case you are interested. It's going to come in at USCB. They roughly have about 2 billion with a B in assets, and they also do about 1.9 billion with a B in loans. So this is a locally grown institution. It's an institution that understands what's going on in South Florida. And the gentleman that we have on is actually Richard Alfonso. Rick's the senior vice president. He's director of specialty products. So we're going to talk turkey, what's really going on in the condo association world, and can his institution or maybe any other institution help you to sleep at night if you're a unit owner or you're a board member and you're facing a big special assessment come 2025 as a result of the structural integrity reserve study requirement. So that's a long way of saying, Rick, how's it going?
It's doing great. Glad to be here and look forward to being able to perhaps help some of our fellow neighbors with their concerns for those that live in condos and HOAs across really a state, not just South Florida anymore. It's really the state. So I think that the Surfside tragedy really caused some eyes to be open and statewide, which is probably a good thing. People have to start really looking at where they live, and make sure that it's structurally sound. Hopefully we can help them.
Now, I want to talk a little bit about you, but let me sort of set the foundation or the baseline, if you will, for the audience. So Surfside collapses June of 2021. As a result of that, insurance companies pay out roughly about $1 billion goes to the families of the 98 victims of this tower collapse. Federal investigation is currently underway. Preliminary reports suggest a structural design flaw. So the way they laid it out, as well as a lack of upkeep on behalf of the association. There's some attorneys out there saying that basically the association was aware of what was happening over in Surfside, where the 98 people died in the tower collapse and international headlines were made because of it. But some of the talk was that roughly the association had about $750,000 in reserve, but they need about 15 million with an M in order to get the sort of the work done. So the Florida legislature, to try to keep the insurance companies still around and willing to finance condo associations, they put in place a number of requirements that are now forcing associations to not only study what's wrong, but actually fund it. And that is basically the difficult part for board members and unit owners, especially if you're an investor. You don't want to waste money on that type of stuff. So that's kind of the baseline, Rick. I want to get to some of that, but before we do, I want to sort of talk a little bit about you. Let me sort of lay out your resume really quick, and then I want you to fill in the gaps. Basically, you got your bachelor's at Florida International University. You got your master's at the University of Miami. You were doing financing with your own company between 2003 to 2013, an organization called the Clayton Group. From there, you went to Florida Community Bank. We did condo association financing. And then since 2016, you've been working at U.S. Century Bank, where you are doing financing for condo association. I get that right?
That is correct. You hit it right on the head.
Rick, why condo associations? What interests you about that? How did you get into that? It's not are you a condo commando, for instance, or what struck your interest?
I think just from an interesting standpoint, when I had my own entity that I unfortunately had to close due to the 2008 financial crisis, and actually had to reinvent myself, I was actually approached by Florida Community Bank to actually launch an association banking product for them. And the only reason why they kind of talked to me was because they saw the entrepreneurial, I guess, background of being able to start something from scratch. So basically, even at Florida Community Bank at that time, we were able to launch that product throughout the state, basically from the I-4 corridor south. And it was just kind of another product. It was like selling widgets. But since that point, really have become pretty well involved in this area. Know almost all, if not most, of the management companies, deal with a lot of the associations here in this area, in the Dade, Broward, and Palm Beach area. And we have just found, especially here at U.S. Century Bank, we have just found this niche to be able to help our fellow neighbors, not only from a lending standpoint, but from a depository standpoint and from an operational standpoint. We've been able to kind of create this product to help them, to make it easier and less expensive for them to run their associations. At the end of the day, I don't have to tell you, the association is a business. So it's a function of trying to get the right partner to help you run your business. And we've just been able to do that. And I enjoy doing that, right? I get to talk to different people every day, all over the state. And it's just, it makes coming to work exciting from that standpoint.
That's fascinating. And let me provide some context for the audience. Roughly, there are about just under 29,000 associations in the state of Florida, according to the Division of Condominiums, Timeshares, and Mobile Homes. And there's about between 1.2 and 1.3 million units. Now, if we carve out Tri-County, South Florida, which would be Miami-Dade to the south, Broward County to the middle, and Palm Beach County to the north, for any of our listeners or viewers who are overseas or outside of South Florida, you're going to have about 610,000 units with about 13,000 associations. So a good chunk of the 1.2 to 1.3 million units in the state of Florida is going to be concentrated right down here in the Tri-County area. And as a result of that, we have all types of different people running these associations. Some of them know what the hell they're doing. Some of them don't know what they're doing. They're all volunteers for the most part. I'm not aware of any association board members who are actually getting paid to do this. They vote on whatever platform they want to vote on. So, Rick, what kind of situation does that create for you as a lender who might be willing to provide financing one of these associations? If you're talking to somebody maybe who does financing or has done financing, or maybe somebody who's a retired whatever, and they want to run it their way, they want to be a condo commando. So, what are some of the intricacies involved with that?
It's interesting. We're not really finding a lot of associations that are self-managed anymore.
Okay.
Most of the associations have signed up with a management company, big management company or small management company, right? That's their choice. But we have found that they are leaning towards professionals in this industry to kind of help them with the process of running their association. That does not mean that we don't have condo commanders that think they are smarter than the management company or than the manager. And those are situations that we have to deal with on a case by case. But for the most part, we are dealing with managers that are licensed, that understand this business. And for the most part, they all have the best interest at heart of the association, which makes it, the boards may not realize it or understand it, but they really are there to help them and to protect them. And we kind of, as a bank, we try to focus on those associations that do have management companies, for the reasons you just mentioned. The ones that are self-managed, some of them are self-managed very well. I've seen some self-managed properties that have some individuals that are on these boards that are, again, like you said, are volunteers, but they were true financial professionals in their personal career, and they understand how to run these things like a business. That, unfortunately, is not the case in all of these buildings.
Now,
we
to
do
make
run
it,
into that problem.
I'm sorry, to make it kind of simple for maybe somebody who's out there, they're trying to figure out, how does this kind of work? I kind of get it, but I don't. Let's, correct me if I'm wrong, but let's look at like the city of Miami. So city of Miami's got a bunch of commissioners who were elected, and then there's a bunch of professional staff who are actually expert certified licensed. And this professional staff provides recommendations and suggestions to the elected officials. So the elected officials don't need to know that, but they need to know what to tap into, if you will, if they have questions. Is that kind of the same way most associations operate in the state of Florida?
Yes. Now, having said that, though, remember, Florida statute sets out the real parameters and guidelines of how you're supposed to run your association. And the manager or the management company's job is to make sure that the associations are acting within that Florida statute. So the rules are set out there.
Yep.
It's pretty easy for the board to run. They may not like the solution or they may not like the answer, but the rules are there that they need to be following. And at the end of the day, these board members, what they don't really recognize is they do have a fiduciary responsibility to their fellow neighbor. This is not you're basically running an association that controls the home that you and your neighbors live in. And there's a responsibility to that. Some take it seriously and some don't.
Yeah. And speaking of which, talking about some of the revisions that the Florida legislature made as a result of the Surfside disaster, 2021, they now attach possible criminal penalties going up to a third-degree felony for violations on behalf of board members, and they're not doing what they're supposed to be doing. And it's across the board in terms of what the legislature is currently looking for. They're looking for disclosure, sharing of contracts, or they want to make sure there's nothing funny going on with voting. They also want to make sure that the board members have this fiduciary responsibility where they represent the unit owners and they're not doing anything on the side where maybe there's bribery and that stuff. So the legislature is getting sort of serious about it. They're also bringing some transparency. I wonder, as a lender, can you walk me through when you first got going with condo association financing back in 2014 with Florida Community Bank versus today? How much more can you find out now versus what was going on back then when everybody sort of kept their elbows out and they weren't letting anybody get close to any of the information? Has it changed much or is it still the same?
I have to tell you, as a lender, it really hasn't changed much because as a lender, we're asking them for particularly specific information with regards to what they're borrowing the money for. So we really do have the opportunity to see contracts, talk to the contractors, we're talking to the different individuals that are in the project itself. So I can't tell you that I think that it's any different from a informational standpoint. I think that from a requirement standpoint, there's some differences between today and 2014 because the Florida statute's changing. But those are things that, just like anything else, the boards and the management companies are going to have to get used to once those rules are kind of set in stone. And then us as the lenders, those are the rules we have to follow. So for us, it makes it kind of easy to have a roadmap, right? If Florida statute is requiring you to have an audit at, if your revenue is 500,000 or greater, well, guess what? It's not me asking for it. It's Florida statute. So it creates a even playing field for everyone. It's just that challenge of starting to follow it and going down there. I think that the next 6 to 12 months will be a little painful because people are getting used to all these new regulations that are in place. And I think after that, it'll just be commonplace. and everyone will be following it, and everyone will be doing it at that point.
Now,
so
I want to ask you, about some of your product, but before we do, based on what you just said, there's a representative, Florida legislature down here, representative called Vicky Lopez. She is she's a Republican. She represents Key Biscayne, a good portion of Greater South Miami. She went on the local public radio station, WLRN down here, and she gave an interview where she said she would not buy a condo until 2026. Primary reason is that you have structural integrity reserve study. This is that study to make sure that, the experts tell the board members what's wrong and how much they're going to need to set aside to sort of fix it. So Representative Lopez's thought was, it's basically the Wild West right now. Nobody knows what to do. And if you want to be, cautious, you don't want to pull the trigger on a condo in 2026. So I just wonder, from everything you're seeing, are you seeing this chaos? And I'm not asking you to say Representative Lopez is correct or incorrect. Are you seeing chaos going on behind the scenes as a financier with some of these associations? Or is this maybe just a lot more scuttlebutt over, something that we're going to see play out over the next 12 months?
As a bank, a U.S. Century Bank, we do not finance personal purchases of homes, whether it's a condo or a home. We're just not in that space, right? We have partners that help us with that, but we're not in that space. The space that we're into is lending to the association itself. And what I see are associations that are worried that they just don't understand the true parameters of what rules are being set out. So you have some buildings in Dade and Broward that are very well managed, huge reserves, maybe too much reserves, right? I mean, just managed like you would like to see anything managed. And you have other ones that unfortunately are not, may not have the same reserves, but it's important to note that Florida statute did not require them to have reserves, right? The Florida statute legally allowed them to vote to not have reserves. That was the rules. That's changing now. And I think that, like with any other change, you have that moment or that period of uncertainty that you got to figure out, okay, how is it that this is going to affect me? How is it, how much do I have to change my budget? How much is it that I have to, redo here to ensure that I'm following the new rules of the game? So I think that I think it's more uncertainty, not chaos. I just think it's that period of time to figure it out. And personal investments are personal choices, right? So that's up to the individual themselves. But I think that come first quarter of next year, we will, I think people will be a little calmer, and I think people will understand where are we. I think people will have put into place the things that they need to do. As you and I were talking before offline, the other part of the tsunami is the insurance cost, right? So you have these associations that, okay, I'm going to increase my budget because I now have to reserve, or I have to come up with that number. But then you have this unknown of the insurance expense where I've seen it double, triple, and sometimes quadruple for some of these associations. That's real money, right? That's another big number that has nothing to do with the Florida statute being changed. Is just another parameter of cost being in Florida. And to be honest, that affects all of us, right? Whether you have a home, condo, a townhouse, that's kind of across the board on the insurance side. So
now, just to give context, and I'm not really going to discuss this right now on this podcast. This will be an upcoming podcast as well as some reports we do. There's a brand new study that just came out, and what the study's saying is roughly in Miami-Dade County, the average price per square foot per month for a condo owner is about $1.15, 1.15, of which 21% is earmarked towards insurance. The study looked at roughly just under 4,000 associations nationwide. This by far, Miami-Dade County was highest aspect of a budget earmarked for insurance. I don't want to get into too much of that right now. I haven't had a chance to review the study, but I wanted to provide some context for the audience. Any thought on what the ratio should be, Rick, in terms of when you're underwriting some of these associations and the people who maybe you might not be financing individuals, but you are financing the associations, the units that are in the association, and those people have to pay in order to cover the note every month, correct?
No, the way we work is that we lend to the association itself.
Okay.
So we are not leaning or putting mortgages on the units within the building. Our collateral, if you will, are the rights of the associations to lien and the special assessment itself that's being passed. So from a financing standpoint, we really aren't affecting the homeowner themselves. Now you have some like I was just talking to a building now where they decided to self-fund. So they basically told the owners, hey, you either take the money out of your savings, get a home equity line, do whatever you want to do, but we're not going to get a loan from a bank for the association. That becomes an association decision. For our clients, it's basically that. Our client is the association. Our collateral is the rights of the association. We do not ask for personal guarantees. We do not mortgage any of the properties or any of the units within the building.
Okay, fascinating. If we could just drill down a little bit, just so the audience understands, and I get it as well. So let's say a 300 unit condo. So you got a 300 unit condo, you got 301 folio numbers. From the taxing perspective, why one folio would be the common areas, the other 300 would each be the units. So we got 301 folios. We got 300 units. So in a situation like that, you got a board of directors. Let's call it 3. We'll just keep it at 3. So we got 3 board members, 300 units, 301 folios. And they have a property management company, which is outside. It's professional. It's licensed. It's top notch. So how would that go on? The association board members would get the bill as to what's going to be coming down the pipe for special assessments or anything else. They're going to deal and talk with their property management company. Property management company is probably going to suggest some institutions such as U.S. Century Bank. And then you will simply come in there. You will provide some sort of proposal. And then the association would decide who they're going to go with. Am I right so far?
Yeah. And it just depends on what type of loan they want. So if we can talk about that for a moment.
Yes, please.
So you have loans which are for certifications, right? 40-year, 30-year recertifications. They got to do roof. They got to do concrete restoration, paint, whatever those, whatever may be entailed. Maybe they want to redo their common area. Who knows?
Okay.
From that standpoint. But in addition to that, and something we're talking about here is that we can also provide a loan to fund reserves. So with this statute being changed now in January, where they're going to have to start reserving, most associations are going to have to get reserve studies if they don't have it already. So that reserve study is going to kind of tell them, hey, this is where you're at from your timeline on the life of things. Your roof has 10 years left, your paint has X, whatever it is. This is how much you should have in the bank today to cover your expenses X number of years from now. And this is how much you have to add to your budget in addition to that. So what they're going to be looking for as sort of one-time special assessment or perhaps a loan is, hey, I need to have $1 million in the bank today in order to be compliant with Florida statute. Mm-hmm. And then I've got to collect another $1 million over the next 10 years, right? So my reserves have to go up by X in order to accomplish that. We can lend them on that $1 million so that they become compliant and give them 5, 7, 10 years to repay it. So that hardship, that financial hardship to the unit owners is manageable over a period of time, and they don't have to stroke a check or get a HELOC or whatever to come up with that money day one. It's just an option for the association. But to go back to what you were saying is that they're going to go out to bid. They're going to go to, the different banks in this area that do this type of lending, and they're going to get a proposal. The board then is going to review those proposals. They're going to pick one. They pick U.S. Century Bank. At that point, they're then going to provide financial information to us on the association, not on themselves personally, just the association. Mm-hmm. We will underwrite it. If approved, we will give them a commitment letter. That commitment letter then is approved by them. And then usually they have to give the 14-day notice for the meeting to approve the special assessment, approve the loan. They will have an attorney. Obviously, we recommend that they have an attorney that reviews loan docs and reviews all of the documentation. That attorney would also provide us an opinion letter that states that they've acted within the rules of their condo docs. Mm-hmm. And then we move to closing. So the process is pretty straightforward. It's pretty easy. It just takes time because of the specific time frames that you have to hit.
Got it.
We calculate that from start to finish. Once they've given us everything, you're talking between 45 and 60 days to close the loan.
So it's a 60-day process. In residential real estate, and this is different, but typically when you get a mortgage, there's like a loan to the LTV, loan to value ratio. Is there like a percentage in terms of you guys go in there and you'll assess it? Okay, this association can bill out so much, or they can assess so much. Therefore, we're going to go 50% loan to value. So let's say they need $1 million, you'll give them a loan for 500 grand, or maybe not you specifically, but generally, what is the common rule of thumb for a loan to value on one of these types of loans?
I mean, we look at the values of the properties, but remember, we're not lending against the property itself,
Okay.
right? So the value of the property does play into it.
Okay.
If the units are worth $100,000 and they're asking for $10 million, we've got to really see what the problem is. But we really don't run into that issue. What we really look at is we want the special assessment to not be greater than 75% of their normal maintenance fee. On occasion, we'll go up to 100, but 75 seems to be kind of the right number to be at. So what does that mean? If you're currently paying $500 a month in your normal monthly maintenance, we want to see the special assessment to be approximately no more than $400. So your new assessment is going to be $900 a month, right? But that's really where we gauge it at. And we have found over the years that number works with the owners and with the association. The real unknown here is when we start looking at the 2025 budgets that'll be coming out in November. We don't know what insurance is going to be. We don't know what they're going to need to do for reserves. So that unit that's paying $500 a month now, maybe that is going to be $900 a month just regular in 2025 because of insurance and reserves. So our concern as a lender at that point is, okay, if I layer on top of that a loan that now is going to take their assessment to $1,500 a month, well, that's triple what they were paying in 2024. And I think that's the part that as lenders and as community owners and as condos themselves or associations, that's the part that we have to kind of flush out over the first 3 to 6 months of the year to figure out, where that number is going to be. But from a parameter standpoint, we want to see delinquency less than 10%. We're probably the most aggressive in the industry right now. So those are really the two things that we look at that kind of stick out up front. I mean, obviously they have to have their financials in place and be in good order, and they have to get approved from our credit underwriting team. But that's what we look at. And I think that those are the things that are going to be sticking points in the first quarter of next year.
Okay. And let's just follow up with that. So the 75% basically, whatever the special assessment loan would be, let's say in this circumstance, it's got to be 75% roughly of what the previous maintenance fee was. Now going forward, do you guys actually mark to market it? Do you adjust it? So if there's an increase in maintenance of 20% the following year, are you simply going to is it going to be tethered and track with, so it stays in stuff? No.
It stays, we provide the associations fixed rate, fixed principal and interest loans.
Okay.
So, and primarily because of that, you can't give an association a variable rate because as rates go up, now you're just continually going back to the association telling them, hey, your new payment is this or this. So they're fixed terms, fixed rates for the 5, 7, 10-year period of time.
Now,
no balloon, it's equally principal and interest amortized over the period.
Now, in terms of rates, can you give people an idea in terms of how it comes in? And let's again apply it to like residential real estate, because some of our audience members, they primarily deal with mortgages rather than anything else. It's based off 10-year treasury plus a typical mortgage, generally speaking, whatever the 10-year treasury is for the audience. You're going to add about 3 points in general to get an idea what your mortgage should be. Is there any kind of way that the audience can understand, like what kind of interest rate one of these special assessment loans might come in at ballpark?
Yeah, these are commercial loans, right? So it's not a personal loan. So it's a commercial loan, but we do it the same way. We tie it to the treasury. So if it's a 5-year or 7-year or 10-year, we tie it to the treasury, and the spread is anywhere between 295 and up. Right, 295, 300. So it's pretty, because we want them to understand where the rate's coming from. And it's an aggressive rate, if you will, for the market that it is and for the period of time. And then there's no surprises, right? It's not like we're pulling that number out of the air. They know what it is. We close it, we fix it the day of closing, and it is what it is.
And, I'm just curious, there's certain, and you're not an accountant, you're not a tax specialist, you're a lender, but I'm just curious, there's a lot of interest that you're able to write off in theory. If you have a mortgage, again, as an individual, and you're talking associations, but just to throw it out there, when a special assessment actually has to be paid out and there's an interest associated with that, do you have any idea? Is that actually tax deductible, generally speaking? Or is
remember that the association is a not-for-profits, right? So at the end of the day, they have no income. They have no, so there's really no, that would be a question for an accountant. Yep. But as a not-for-profit, there's, at the end of the day, they're not paying taxes anyway. So
Got it. Now the typical term.
They're collecting exactly what they need to pay out at the end of the day.
Correct. And again, the term of one of these loans, typically 5 to 7 years, or is it based on how long the job's going to take?
What we're actually seeing, because the loan amounts are increasing, we're actually seeing the term requests ticking up. So, 5 years ago, you would see loans 3 to 5 years. The associations would just want to get rid of it.
Yes.
Today you're seeing requests 7, 10, even 12 years.
Wow.
I think anything over 12 years, that becomes a mortgage, right? I mean, at the end of the day, you're basically financing a mortgage here. But yeah, we're seeing it tick up a little bit because of the dollar amounts.
And I'm just curious. So maybe like a U.S. Century, or maybe not a U.S. Century, but generally speaking, when a lender puts money on the street for a situation like this, is this something they portfolio and they keep, or is this something that they sell off, or they create tranches maybe where they bring in other investors? How does that normally play out? So in other words, is the risk all on U.S. Century or on the lender, or is it somehow diversified?
At the end of the day, that's a question that you need to be asking kind of the CFO and senior management. I don't get involved with what we do with the portfolios. So my job is just to kind of bring it to the table, and then the powers that be do what they want to do with it at that point in time.
All right. And one other question about product type. So we were talking about how the association's actually taking out the loan, and you have the ability basically to collect off of the special assessment. I'm just wondering, worst case scenario, you need to foreclose, or you need to try to collect on your money. Somebody goes bad. What is the process, and who would the bank actually go after? Just so the audience can understand, and so it's real crystal clear to them.
Keep in mind that our client is the association.
Correct.
So
which is a non-for-profit.
The association's job is to collect from its homeowners.
Correct.
So if you as a homeowner have a financial problem and are unable to pay, the association has to go after you under the laws, under the Florida statute, the way that they have to go set up a payment plan, whatever it is they do with you. As long as they keep paying the bank or paying the loan, we don't get involved. We're not going to get involved with your particular unit or your particular situation.
Okay.
We will do annual reviews of the loan. And an annual review is we'll ask for, financials, tax returns, their aging report, just to make sure that the association is still running the same way that it was.
Okay.
If we see that the aging gets greater than 10%, we're going to ask, hey, what's going on? What are you doing with these people? They may still be current with their loan. Maybe they're using money from reserves to cover the shortfall. They're not paying something else, but they're still paying the loan. But we will ask what's happening with these particular clients or these particular owners. If the association were to default, which you probably know as well as I do. I mean, even in 2008, when the world came to a financial end,
yes,
I did not hear about banks foreclosing on association loans, right? People are going to pay where they live because they don't want to lose their home. But having said that, let's say one does go bad. The bank basically is going to enter into and become the board. And at that point, I think everyone's going to get leaned at that point. It becomes a whole different situation for the bank to try to get its money and pay. But we basically become the board.
Wow.
Not that we want to,
yes.
right? That's not the intent.
Yes.
But basically, if we were to have to foreclose, that would kind of be the step.
I see. So the language of the loan, in other words, give you the ability to basically usurp the board of directors and take control and seize it in terms of the management control.
Right. Yeah. Correct.
Interesting. Yeah. I had no idea. So that approach has to do with like special assessments. You mentioned a different product, and that's like a one-off job. Maybe you need to redo the lobby. You need to do something like that. Is it going to be the same type of structure, or is there any kind of difference?
Same structure, same special assessment. Sometimes a board may decide to make it a budget item instead of a special assessment.
Okay.
That really becomes the board's choice. But it'll be handled the same way. It would be handled the same way.
Got it. Now, some lenders, and I used to be a banking columnist. I worked over at the Miami Daily as a business review, wrote about banking. I find bankers fascinating, the way they do things. One rule I remember from some of them was I got to be able to drive to it. Typically a lender would say they're going to go about an hour and a half ride each way, depending on traffic. That could be like, that could be like 5 miles in Miami.
Yeah.
But do you have any kind of rule in terms of where U.S. Century Bank wants to finance, or in any kind of strategy you have with your team? So maybe somebody's listening to us in Orlando, maybe they're in Tampa, they're in Naples, they're in Jacksonville, they're outside of the Tri-County, Miami-Dade, Broward, Palm Beach County, maybe Monroe. Could you give the audience some idea as to, what you'll take a look at geographically?
I mean, we will do anything in the state of Florida.
Okay.
So, and we have clients that are outside of the Dade, Broward, Palm Beach area. So we do not have a 1 hour drive limit. We will go wherever we need to go, to help the clients. And we're seeing with this, new Florida statute coming in, remember that all these certifications only existed for Dade and Broward.
Yes.
Now you have every county in the state with the same requirement. So from a number of clients' perspective, and from just being able to accomplish that, there's going to be a lot of associations that are going to need help. So we're here to help them regardless of where they are in the state.
Interesting. So we kind of have that playing out. In terms of the 2025 budget and or some of the changes coming as a result of 2025. One of the things we started to do, and we're more on the analytical side. We like to look at data. So what we're doing now is we're breaking down condos. We're not looking at them based on the view. We're not looking at them based on how many units. We're not looking at them based on the lobby, the parking, anything like that. We're looking at it based on the age, and we're categorizing condo buildings based on, if you were new, 0 to 9 years old, we're calling you new. Why is it 9? Because at year 10, you have to do one of these structural integrity reserve studies. Every 10 years, you got to do it. So the first 9 years, we're calling you new. The second phase, which would be 10-year mark, where you've done your structural integrity reserve study. Now you got to put money aside, up to 24 years, when another study kicks in called a milestone study. We're calling you used. And once 25 years comes under the new rules, basically you got this milestone study. So 25 years or older, we're calling it vintage. So we're saying you got vintage, which is anything plus 25. And keep in mind that changes every year as the building gets older.
Correct.
Yeah. So I guess what I'm wondering is when you're considering, or if anybody out here is listening or watching, and they're saying that, I got this particular age building, do you guys have any cutoff? Like, we'll only do our definition new, which is up to 10, or used, which is 10 to 24, or over 25. Like, will you guys touch vintage? Will you touch used? Will you touch new? You don't care because it's all financial. Can you give the audience some perspective on that?
I think most of our clients right now are vintage.
Vintage.
And
Okay.
it's just the nature of the beast.
Okay.
Right? Those are individuals that, are at a point right now where they probably need to have some work done. Some of them reserved, some of them partially reserved, some of them didn't reserve. And even the ones that reserved are finding that perhaps they didn't have enough reserve. And things are more expensive than they anticipated that it was going to be. And they'd still need to go out and get assistance from a financial institution. we see your other clients of new and used, but not as much. Those are more banking relationships. Those clients really are not in the market for lending unless they really want to redo their lobby, or they want to do something that's more aesthetic, or they just have to, it's not usually a structural issue. So we have seen that most of our clients are on the vintage side. And I think that's just going to be throughout the state is what's going to happen.
Got it.
Unless something comes up on one of these SIR reports that they just didn't expect, which is, what the SIR report is for, right? It's to kind of preempt any issues. Then maybe we would get a new or used property that is trying to fix something that they didn't know was there. And then the SIR report would have done its job, right? It would have brought something to light that perhaps would have been ignored for another 10 years.
Okay, great point. And for the audience, one of these SIRS reports, Structural Integrity Reserve Study, in order to do so, a board has to hire an engineer and or an architect to go through. What they do is they go through it, they make sure that everything is on the up and up, it looks as this, they identify issues. And then on the other side of it, they have somebody focused on the reserve side to make sure that they got the money that's allocated, just so you get an idea. So it's not somebody who's a board member going out there and taking a look and saying, oh, everything looks fine. Oh, the roof's got another 10 years. You actually have to bring in an expert to assess that. And that's how the boards make the decisions about what the special assessments will be and what everything else going forward will be. Am I getting that right, Rick? Or is there anything you need to correct?
No, that's correct. And those engineers or architects are signing that they have reviewed it and that what they found is what they found, right?
Yep.
So there is accountability there.
And the accountability, from what I've read in the law, is not only on the civil side, but it could be on the criminal side, in addition to revocation of license. So it's pretty severe, which is a great transition to a meeting I had with a engineering company. So I went up to Hollywood, I had lunch with an engineer, and I was talking to him about these SIRS, Structural Integrity Reserve Study. Anybody who doesn't know what an SARS or SIRS or a SEERS, whatever it is, this is something you need to know if you're going to be investing in condominiums in the state of Florida going forward. So I had this lunch with this engineer, and what he was telling me is everybody in the state needs to do it. When Hurricane Andrew hit and changes were put in place back in August of 1992, legislature took steps to keep the insurance companies here. Most of those changes were Dade and Broward County. You didn't have it statewide like Rick suggested. Well, what do we got? 67 counties in Florida. Everybody's got to play by the same rules now. And the problem is there's a lack of engineers to go ahead and actually check this stuff out for the Structural Integrity Reserve Study. So Rick, what the engineer told me is our reports cost up to $100,000. And if you give us the money today, we're going to see you in 6 months. So I'm just wondering if you're putting money on the street for one of these associations, I'm assuming it's mandatory that you're going to need to take a look at a SIRS, Structural Integrity Reserve Study, before you actually finance, or is there a way to maybe do a bridge loan before the SIRS can be completed? Because again, this engineer told me it couldn't take them 6 months to send somebody out there because they're so slammed. Can you kind of talk to that issue for maybe somebody who's right now in limbo?
I think that for any association that has not engaged the professional to do a SIR at this point, you're basically behind the 8 ball for 2025. Now, whether the Florida statute allows for an extension or allows for some type of remedy, I've engaged them, but they're telling me they can't start for 6 months. I am not sure if that's in the Florida statute. It may, that's something that would have to be looked at. From our standpoint, once that Florida statute goes into law or goes into place, we're going to follow it. Now, that doesn't mean that if they don't have the SIR in hand today, but if they can show that they've engaged the insurance company, they engaged the engineer or architect, they have paid them, it's going to get done. We have things that we can do to kind of make it after the fact or kind of look at that, but it would be on a case by case basis. Just like the reserve studies. If they have not engaged the right company to do their reserve studies, they need to have that done by January as well. And like you said, before it was just Dade and Broward County. Now you have every county in the state, every building over 3 stories. All you got to do is drive up and down A1A or drive up and down 41 on the West Coast. There are a lot of buildings that are greater than 3 stories. and a lot of buildings that are vintage, to your point, right? So they're going to be busy. And the engineers, architects, they're going to be busy for quite some time.
Now, in reading the legislation, one of the things I saw is what you referenced. 3 stories or higher is where the requirement kicks in for the reserves, the SERVs, if you will. Will your banker touch a project that is only 2 stories and maybe doesn't have to adhere to the same type of policies as a building that's 3 stories or higher? Is that something you'll consider?
We will consider buildings as small as 30 units.
Okay.
The only reason why, the smaller buildings or the boutique buildings that may have 10, 12, 15 units, it just gets too, unless it's they're very well reserved or they're very well, from a maintenance standpoint, structured. Usually the assessment becomes so big that it's double or triple what they're currently paying. So it just becomes financially very difficult to do. We have found that a 30 unit building or greater is kind of the sweet spot for us. And we'll do single story or double story. I mean, we've done townhomes. So we're not focused or only geared to 3 story and above. We're open to any and all of the associations as long as they are credit worthy to move forward with.
Understood. Playing off the engineer part, where there's a labor shortage, if you will, skilled labor to do this. What about on your side? 29,000 associations, state of Florida, 1.2 to 1.3 million units. All of the state has to adhere to this. Is your team growing? Are you adding anything? Anything you can share with the audience in terms of how you're preparing for what seems to be a tsunami of probably interest coming from associations?
I mean, we have a great staff here. We're staffed to the point where we could probably handle the part of that business that would come to us. Obviously, we have competitors or other banks that are friendly competitors and friends of mine that are in this space as well. So we have found over the years that there's plenty of business for everyone to go around. And yes, there's more business that's probably going to come because of these buildings that need the reserve fundings or specialty financing products just to kind of get them over the bridge. But I think from a staff perspective and from a back office perspective, we're ready to absorb that and to move forward with that.
Now, one last point I want to kind of ask you about before we sort of wrap up this podcast is Silicon Valley, in my opinion, they make technology. And based on the technology they're making in Silicon Valley in California, it spreads not only throughout the country, but it spreads throughout the world. I like to make the argument that South Florida, especially, we make condos, and what we do here spreads throughout the state as well as the country. I'll give you an example. The Florida legislature has taken steps as a result of Surfside collapse. State of New Jersey has now adopted legislation to kind of deal with this. The likelihood is that other condo associations throughout the country are probably going to kind of get on board with that. Any sense, anything you want to comment in? Are we really the heart of the condominium industry in the United States? Is there any truth to that, or am I just way out in la la land?
I mean, I'm not sure that, I think New York has a lot of condos and a lot of people that live in apartments and condominiums. I think we are just blessed to be the place where everybody wants to live. So we're not going to have a shortage of individuals wanting to move to our great state. And unfortunately, we are landlocked, or we're ocean locked, right? So we only have so much space that we can build. And that tends for us to build up and to build condos. And I think that overall, we do it well as a state, right? And I think that as long as people want to continue to move here, I think we need to be able to provide a product that's safe, and comfortable and for people to enjoy. And I think that Florida's our legislation has done a good job. Nobody's perfect, but they're doing a good job to make sure that the right rules and the right things are in place to do that.
And then the final area I would just want to, we'll wrap up the podcast with this. So if an association, let's say you got board members, you got unit owners who are listening right now or watching this podcast, and let's just say they don't qualify, they get a loan from maybe U.S. Century Bank or others, their ratios are off, whatever the case may be, and they're facing what's called termination. termination is basically the recycling of a condominium association where a supermajority of unit owners will vote to basically sell as one entity to an individual or a development entity. That entity will then cancel the termination, simply ripping up in layman's terms the declaration of condominium, and then they can go ahead and knock it down. So I'm just wondering, from a termination perspective, in a loan that maybe you have in place that's going out 5-7 years, whatever the term might be, what happens in a scenario like that? Maybe they take out a loan with you. Along the way, there's other things that are unexpected, and the association has to move to terminate, or they decide to terminate going forward. How would that scenario sort of play out?
I mean, that's actually you owning your home and you want to sell your home when you have a mortgage.
Correct.
And we're going to have a lien on the property. The builder or the developer that comes in is going to want to have a clean title. In order for them to have he or she to have a clean title, they're going to have to pay us off. So from the bank's perspective, it would just be an early payoff. And the building would go on and do whatever it feels necessary to do at that point.
Okay, that's great for clarifying it. And then in terms of order, in terms of collectability, the lender's ability to go ahead and collect, I'm assuming that the tax man or woman, IRS, is going to be number one. You guys would be like what, in the second position? Or you would somehow...
I mean, if they have an IRS lien, we probably won't touch it, or we'll probably make sure that that IRS lien is paid off. We want to be in first. We want to be in first position.
You want to be in first position. That's how you get there.
Yeah.
Okay. All right. Rick, am I missing anything? Did I overlook anything? And thanks for carving out an hour of your time to talk condo association. Who would have thought we could talk about an hour? But I could probably keep going. But I told you, I promised you, we keep it under an hour. Am I missing anything maybe you want to hit on, or do you want to send a message out to the audience, whether they're a unit owner, they're an investor, or they run a condo board, or they manage their properties?
I think that from a condo board standpoint and from the owners, I mean, I just wouldn't be scared. I think that these changes are a good thing for our condo associations throughout the state. And like anything else, change sometimes brings a little bit of chaos. But I think that if they trust their management companies and if they trust the managers that those management companies have put in there, and they follow those rules, I think they'll end up being in a better place. And we're here to help them. They're not alone. They've got different individuals and different entities that can help them. It's just a matter of reaching out and asking.
And Rick, if somebody wants to reach out, what do you suggest? Is it email? Is it telephone? Is it the website? Can you sort of tell the audience how they can get a hold of you?
If they want to reach me, the best thing is probably email. Okay. I don't know if you want to put it up. You want me to give it to you, but it's,
you can give it to me, and then I'll also post it in the show notes.
It's Richard Alfonso at uscentury.com. That's usually the best way, and we'll be glad to help.
So on behalf of Miami Real Estate Investing Podcast, I want to thank you for carving out time to discuss financing for condo associations, not only in South Florida, but in the state of Florida. That is Rick Alfonso. He's a senior vice president. He's director of specialty products at U.S. Century Bank, which was established back in 2002 in the Miami area. They have 8 branches throughout the South Florida region, but they're willing to finance anywhere across the state of Florida. So thank you, Rick. Much appreciated. So until next time, I would just encourage the audience to check back for another part of our series, focusing on the 2025 Condo Association Financial Cliff in the state of Florida and what players are doing to try to help the community kind of get through and without any kind of drama. So thanks for tuning in, and we'll catch up soon.
This special report examining the repercussions of Florida's 2025 Condo Association Financial Cliff was brought to you by the Miami Condo Market Investing Club trademark. The objective of the club is to build a community to share real-time, actionable information on the latest real estate trends and opportunities in the Tri-County South Florida region of Miami-Dade, Broward, and Palm Beach. The club is ideally suited for do-it-yourself DIY condo buyers who can rely on our latest statistics, expert opinions, and access to consulting services. To find out more about the club, please visit peterzalewski.substack.com. Additionally, we encourage you to listen or view our podcast wherever you get podcasts. The podcast is available on Apple, Spotify, and/or YouTube. As a reminder, we are always available for consulting, expert witness work, and buy-side brokerage services, just as we have been since 2006. For South Florida condo resale information, please call 305-865-5859 or visit condovulturesrealty.com. This information is believed to be accurate and complete, but cannot be guaranteed or warranted.